Welcome to Darwin's Theory.
Hello, Dr. Darwin here again. Today I want to talk about a couple of things that are really important. And it's basically a summary of some of the other things that I have talked about. But I really feel that there is a crying need for people to understand exactly how this works and exactly what your options are. Now, I'm going to be a little bit frank about some things, so take it in the spirit in which it is intended, and that is that I really am trying to help. There are some things going on right now in the world. You're completely aware of them, and they are having a long-term negative effect on the economy, on the US dollar, and on your ability to save, to provide for yourself in the long run, a lot of those kinds of things. So I'm going to review very quickly banking, the Fed. I'm going to talk a little bit about crypto exchanges so you understand what they are. And then in a subsequent video, I am going to talk about exactly how you go about getting into Bitcoin. But that's the next video. So right now we're going to talk about banking, the Fed, and the crypto exchanges. So let's get started. A quick review of banking. When you put money in the bank is the legal owner of your money. I'm not sure how many ways I can say that, but understand that that's exactly what happens. You gave them your money, period. They can use it for anything they want to use it for, and quite frankly, they don't have to give it back to you. So they could use your money to get them out of trouble. And if you think about it, it's truly a regulated Ponzi scheme. There are only certain people who are allowed to be a banker. There are only certain functions that can be done by a bank. Number two, they spend your money as they choose. It's usually collateral for mortgages, but only kind of sort of collateral. Because let's say that they have $100 and they would like to loan out $1,000. Can they do that? Absolutely. That's so funny. So that's number three. You're at the mercy of how much money the bank wants to create. That is, how far out on a limb do they want to go? And when the bank makes a loan, it literally creates money out of nothing. That's your money supply. It creates money out of nothing. That's that same example. They have $100 and they loan out $1,000. They just created $900. They can. It's legal. They can do that. Now, if you try to do that, that's not going to work so good. When you repay or when you default on the loan, it decreases the money supply and the value of the bank. So a bank is valued on how much outstanding money it has, what it can collect. So it's incumbent upon them, if you think about it, to stay a profitable business, to loan out as much money as they possibly can. That's their reason to be. And since the Fed has said now at this point, you don't have to have a reserve, that means they don't have to have any money to back up the loans that they make. None. Interesting concept. They make a return on your money, and they don't share it with you. Now, what do I mean by a return? Well, let's say right now mortgages. Mortgages is a great one. Mortgages are really fairly low percentage-wise. They're in the 2 to 3% range right now. Interest that is being paid here is their profit, if you want to think about it. That's their payment, and they make a return on your money. They're not going to share that with you. In fact, most of them at this point charge you just for the right to have an account with them and to give your money to them. How ridiculous is that? Second one, there is no requirement by the Fed to hold a reserve in their vault in the case that you want to close the account. So what that's saying is, I have $100,000 in the account, and I walk into the bank and say, I'd like to have my money now. and I would like it in cash. The bank will say, I'm sorry, I can't do that. They don't have cash in their vaults anymore. Or if they do, they have it for a specific purpose, but it's not for you. There is also no legal requirement for the bank to repay you the amount that you have deposited. Now, that's something that's even a little bit more scary. The Fed will probably pay you back if the bank goes out, but it will probably in the future be in CBDC, that is central bank digital currency. And there will be requirements about how you get to use that. And I've done a little bit of a tirade in one of my previous ones about what those requirements may be, but they could be onerous. They could own you. Now, if you think about it, the bank already owns you. You give all your money to the bank, and then you write checks, or you make drafts, or you make electronic payments, or you do something to get that money out of that bank. At any point, the bank can say, sorry, I don't want to give you your money back. Now, before we get into exchanges, I just want to real quickly hit banks once more. When it comes right down to it, you should have spending money in banks. The money that it requires, that you require to be able to get through the month, should be in the bank. Anything else should not be in a bank. It should be in an investment account. This is not investment advice. I am not a financial advisor. I can't tell you how to spend your money or what to spend your money on. And it just makes sense. And it really does just make sense. Everybody who does well has taken the time in life to put away money, to make investments, to do things that will generate some kind of money in the future. Most people think IRA, 401k, SEP IRA, things like that. And those are fine. I'll leave it at that for right now. We should have another discussion about that. But that's a way to put money in a place where it's going to make a little bit of money, where it's going to compound, where there may be tax advantages. When people invest, they generally go to an investment firm, Scottrade, TD America, Fidelity Investments, and there's 1,000 of them out there, literally. And what those people do then is they go to the New York Stock Exchange, or they go to the CME, or they go somewhere and they buy something. Okay, they buy stocks, they buy bonds, they buy commodities. It just depends on what your time frame may be for the kinds of things that you want. Okay, so that's an exchange. An exchange is simply a place where things can be purchased and sold, and there's a lot of volume there, which means that it's easy to buy and sell. So Tesla stock is going somewhere in the $450 range right now, I think. I haven't looked. When you buy a Tesla stock, spend that $450. You bought into a company that makes cars. Okay, when you get ready to sell that Tesla stock, whatever the market says the stock is worth, you can raise your hand and say, I would like to sell my stock. And you will get that amount of money. Again, right now, that's about $450. You can sell it immediately. There's no issues. You call up your broker, you get on your NYSE account, and you click the sell button, and it sells, turns that money into US dollars. You can run that money back to your bank account, or you can do anything else you want with it at that point, including buy more stock. If I say I want to sell, there's already somebody out there who said, I want to buy. And so what the stock exchange does then is it matches you and them. Now we got stock exchange. Let's talk about crypto exchanges. Crypto exchanges are exactly the same, but they just deal in cryptos. Okay, the very easiest crypto buy you can do is one crypto for some amount of US dollars. And so you create an account on an exchange, you transfer some number of US dollars into that exchange, and then you raise your hand and say, I would like to buy this crypto. Now, in my opinion only, and the way that I do things, I only buy one crypto, and it's Bitcoin. Now, you can do anything that you want, but I buy Bitcoin and I hold it. I plan on holding it for a minimum of 3 to 5 years. I'm an old guy. Remember, I'm coming on 70 years old now. And so my time frame for making money is a lot shorter than yours is, most likely. But I'm going to buy it, I'm going to hold it, and I'm going to sell it sometime in the future for what I believe is going to be an incredible number. All right, crypto exchanges. You create an account, you put US dollars into it, and then you buy crypto. Okay, no different than the stock exchange, nothing at all. Now, there are some variations, and we'll talk about that a little bit later. Second bullet. Crypto exchanges are just like what the New York Stock Exchange is, except they deal in cryptocurrencies. So I want to show you real quick what a chart and just a quick example of what trading on an account might look like. Okay, I'm not going to go through it. I'm just going to show it. So this is an example of what TradingView looks like. TradingView is just a charting system, and I don't want to spend a whole lot of time on this right now. I'll do another video about how to buy and sell Bitcoin. It will include something like this, but for now, I just want you to know that there's an exchange out there that is tracking every single, well, not every single, but almost all of the cryptos. Does a constant real-time update. The market never closes, by the way. Unlike the stock exchanges and some of those, the cryptocurrency market never, ever closes. So this is kind of what it looked like. It's really simple once you get into it. People that use a view like this, like TradingView, the reason they use it is because they're actually trading minute by minute, hour by hour, day by day, something like that. Don't do that. But I did want to show you what it looked like, and that there is a crypto exchange out there that you can look at anytime you want and that you can buy and sell from. As for good exchanges, I'm going to leave that for another time because I do want to talk about exchanges and which ones I think make sense for you to be in. And really, the only reason that you want to be in an exchange is to be able to buy Bitcoin. All right, I'm talking to people over 40 years old. Unless you're an experienced trader, do not try to trade Bitcoin. Just buy it. Okay. And again, I'm not a financial advisor and I'm not an investment advisor. But once you're convinced that Bitcoin is the way to go, buy and hold, please. All exchanges will charge you something to put your cash in, to buy crypto, or to get your cash out, sometimes both. The charges generally run anywhere from 6 to about 11%. And I'll talk about that more in the how should I buy Bitcoin thing that I will do. And there are what are called regulated and unregulated exchanges. So let's talk about regulated exchanges. Regulated exchanges fall under the control of the United States SEC or the security regulators in whatever country you happen to live in. They agree, the exchanges, by the way, agree to follow the rules, including both KYC and AML for monitoring your account. So let me define those two. KYC is Know Your Customer, KYC, right? And AML is anti-money laundering. They have a responsibility as a regulated exchange to know who they're dealing with. So if you ever set up an account on a regulated exchange, you have got to have a current picture of yourself. You have got to have a government issued ID, and then you've got to validate your address, usually in some fashion. Once you've got those three things done, then they will allow you to use the account and put money into it and put money out of it. Now, think about this for a minute. Why is it that they need to know exactly who you are? Oh, yeah, taxes. Yeah, that's exactly it. And so the SEC, in our case, the United States, has set up a set of regulatory rules that say you can only be an exchange if you can guarantee to us that you can track all of the money that goes in and out and that you can report it to us. All right. I'll let that one go for now. Anti-money laundering is a whole bunch of money going in, whole bunch of money going out, maybe going to different people. And so the banks monitor, the exchanges, just like a bank as far as regulations go, monitor who it is that's putting money in, where the money's going, and report to the IRS or whoever your local tax authority is what was happening there. If they see what they consider unusual, quotes, unusual activity on an account, and let me define unusual activity for a bank, it is $3,000 to $5,000 in and out in chunks. And somebody, some regulator somewhere has decided that $3,000 to $5,000 is a good indication that normal people don't have that kind of money. And so if they see normal people using that kind of money, then obviously there's something wrong. Scary. They report to the IRS under your name, your trading history. They coordinate with your banks when you deposit and withdraw funds. All right, that's regulation. And there's lots more, but that's a good start. Unregulated exchanges don't have the same limitations imposed by governments. There's a style of unregulated exchange that's called a decentralized exchange, and just like decentralized crypto, they have no home. They have no sign above a doorway somewhere that says, here's our exchange. They're not registered in a country. They don't have a home. They work on a peer-to-peer basis. And so let me talk about that again. A peer-to-peer is I raise my hand and I say, I would like to buy a little bit of Bitcoin. I have $1,000. Who would like to sell me $1,000 worth of Bitcoin? Somebody else raises their hand inside this exchange and says, I will sell you $1,000 worth of Bitcoin. And the exchange handles the transfer. Why it's important for the exchange to handle the transfer is simply so neither person gets scammed. And there are a lot of scammers out. So what the exchange does is it takes the $1,000 from me, it takes the $1,000 worth of Bitcoin from the other person. When it has both of those in its possession, then it swaps them and it sends the $1,000 worth of Bitcoin to me and it sends $1,000 to the other person. Basically, it's a trusted escrow that will guarantee that the transaction works the way that it should. That way you don't get scammed. Excellent way to go. Unregulated exchanges. Unfortunately, right now, and we're in October, middle of October 2020, it's hard to use, even for techies. Now, I've been a techie for like 40 years now. I can make it work, but I really would not like to explain to somebody else how to make that work right now. And so this is a future option. It's not an option right now. The option right now is to use the regulated exchange, and we'll talk about that. So quick summary. Regulated. You make deposits to your exchange accounts so that you can buy and sell crypto. Your funds are maintained by the exchange. This means that just like banks, the exchange owns your money and is not required to give it back. It also means that if the regulators think you're doing something wrong, they can freeze your account. Just like a bank, the regulators have their fingers in it, and if they don't like what you're doing, they can freeze your account, which means you cannot get your money out, period. I'm going to talk about that particular item here in a minute. Unregulated. Decentralized platform. Users interact directly with their peers without any need for a central controller. There's no, and I should have put this in quote, exchange platform. The platform doesn't require that you deposit money or crypto. What it does is it enables through an escrow process the ability to do the transaction. So the funds are controlled by the participants and the users on the platform rather than by the platform itself. All right, centralized or decentralized. So let's talk about those. Centralized exchanges are easy to use. Centralized are subject to hacking attacks. Any exchange, anything that's online where you can go to www.something is subject to a hacking attack. Anything that has money in it is subject to even greater probability of a hacking attack. Exchanges, the centralized exchanges, require that you deposit your money to be able to trade on their exchange, and they all have the normal functions of exchanges. They buy, sell, there's limits, there's stops, there's conditionals, there's insurance, there's all kinds of stuff. You don't care. What you do care about is that central exchanges are easy to use to buy Bitcoin. That's all you care about. Decentralized. They are difficult to use even for techies. You can trade directly from your Trezor or your Ledger hardware wallet. I've talked about those before. I've got some other blogs that show you how to set up the Trezor. I don't suggest that people over 40 use the Ledger. It's hard. Trezor's easy. Let's go with easy. Your money never leaves your wallet until you decide to make a trade. So your money is yours. All right, next. Decentralized does sound better, doesn't it? Well, it is. Technology's just not quite there yet. For now, I'm going to suggest strongly that you stick to the centralized exchanges. Here's a couple that allow most U.S. residents to create an account. So Bittrex, Coinbase, Gemini, Kraken, Binance. Just put a .com after every one of those. Now, there is something cool about what Kraken just did. I personally use Bittrex or Coinbase, by the way, but what was cool about Kraken is they actually got licensing to become a bank. And so now Kraken is not only a crypto authority, but is also a U.S. registered bank. I'll probably do a short video on this and what the effect is, but let me just tell you this. Now, in theory, if your employer has a Kraken account and you have a Kraken account, you can choose how to be paid. Do you want to be paid in Bitcoin? Do you want to be paid in US dollars? Doesn't matter. Kraken can handle it. That's pretty cool. Okay, again, I use these only for buying. I buy and I immediately transfer what I bought directly into my Trezor wallet. Okay, so there's another one, which exchange. I'm not going to spend any more time sitting here, but you can stop this, you can write those down, put a .com after them, and you can research yourself, or you can wait until I do the blog. So this is something you should know about, dirty coins. There's been a lot of talk about dirty coins, and the regulators are getting into the picture and starting to make noises, and so you need to know about it. So what's a dirty coin? A definition is kind of a little bit fuzzy, but basically it's a coin that has been used to do something illegal in the past. Think of it that way. Maybe somebody went onto the dark web, and yes, there is a valid dark web, and it's out there, and people do all kinds of stuff on it and can buy stuff that you really shouldn't be able to buy in any condition. The idea was sometimes in the past, this particular Bitcoin or this particular piece of a crypto was used to do something illegal. And so here's the problem. What's illegal? What's the definition of illegal? And I ranted about this a couple times, and I'll probably rant about it a little bit more. But quite frankly, the definition of illegal changes sometimes by the week. And so that's going to be an issue. So what the regulators are talking about is they may decide that they're going to make a list of all of the coins that have ever been used in the past to do something illegal. All right. A coin is nothing but a set of numbers. It's an address. Okay, and you can track back to the original coin since we have the blockchain. The takeaway there is simply that the regulators can flag a coin and say, if you have any piece of this particular coin, we're going to call it a bad coin. We're going to call it a dirty coin. We're going to call it a questionable coin. And if you have that coin, here's the scary part. If you have a piece of that coin on your exchange account, they have the right to lock up that coin, which means they've taken it away from you. They confiscated your coin. One of the major pieces of the design of Bitcoin is it can't be confiscated. But since you're going through a regulated exchange, it can be. Your coins can be locked up. Your entire account can be locked up. KYC, AML, right? So now we've got this real quandary. 5 years ago, the coin was used to buy cocaine on the dark net. That's illegal in most countries. The regulators feel that this coin has been used in the past to do something illegal, so that gives them the right to lock it up and tell the exchange not to allow it to be traded. As soon as they say that, you can't sell it. You can't transfer it off the exchange. You're totally hosed. That means you can't move it. You can't do anything to it. Now you got a problem. So let's assume that you legally, willingly, with your own money, purchased some part of a Bitcoin that is flagged. Apparently, it doesn't matter to the regulator. They found a dirty coin, and all of the fruits of that dirty coin and all of the history of that dirty coin down to the present time from whenever it was that it got dirty is bad. Now, nobody specifies that this is a clean coin or not. And so when you buy, you don't even have a choice of what kind of coin that you buy in most cases. The regulators can decide to lock it up and take it away from you. And if you've got too much of that in your account, they may just decide to lock up your entire account and confiscate the whole thing. That's why some people actually go to an over-the-counter exchange and specify that when they buy Bitcoin, they want no history on the Bitcoin. They want a fresh Bitcoin. They want one that was minted in the last 24 hours or last month or whatever. And you can actually find those coins. Okay, those are out there for sale. So here's potential solutions on dirty coins. One is that you purchase your coins and move them immediately to your hardware wallet. Okay, now they're not on an exchange. Now the SEC or whoever the regulators happen to be cannot flag it because it doesn't exist anywhere where they can flag it. It is not regulated. That's the key. Not regulated. You can buy a dirty coin, you can put it in your hardware wallet, and you can use it to purchase anything you want anytime in Bitcoin because you can. There's also a way to purchase your coins using your hardware wallet as the receive address so that it is never seen by the regulators. In either case, the coin was clean when you bought it, since you could buy it, and someday, 5 to 20 years from now, when it's time for you to cash this out, or when it's time for you to buy something, you may do so directly from your wallet because it's not regulated in your wallet. And since your coins aren't held on an exchange, you can do whatever you want with them. That's the beauty of Bitcoin. Okay, so there's the tirade on dirty coins. Understand what those are, and that's why I tell you repeatedly, don't leave your money on an exchange. Buy your Bitcoin and transfer it directly as soon as possible to your hardware wallet. Takeaway: don't keep your coins on an exchange. They're subject to hacking, but that's not my real fear. Just like a bank, if it's on an exchange, it's not really yours. Always use a hardware wallet that is under your direct control or with someone who is required by law to keep your information confidential. There is a bunch of stuff you don't know and you don't have to know. So let me put this a different way. You don't need to know how the gas got to the gas station for you to be able to buy it. And in fact, there are a couple states, Oregon included, you don't even have to know how to get the gas out of the pump into your car. In fact, it's illegal for you to do it. So there's a bunch of stuff you don't have to know and that you probably never will know because that's not something you care about. What you're doing is you are investing for your future. Now, I'm not an investment advisor. Again, I have to say that. You decide whether Bitcoin looks good. You decide whether there's a market there. You decide whether, as an investment, it is something that makes sense. Talk to your investment advisor. Okay? The larger investment companies now are saying, oh, wait a minute, we said maybe 1% in crypto. Now there's no limit. They say this is probably the best investment that you could make in the next 5 to 10 years. I don't know. I think it is, and I'm treating my money that way. You need to decide if that makes sense. But back to the bullet point. There's a bunch of stuff you don't know, and you don't have to know. But you still need to know the basics. So when you're satisfied that Bitcoin is something that you want to hold on to long term, and I'm suggesting a minimum of 5 years, then I've created a video that'll walk you through part of that process. Now, here is a wonderful quote that I like. If you are risk adverse, you should have most of your money in Bitcoin. If you don't understand that, study more. So, a couple things over here up in the orange. I know this was a whole bunch to take in. You really probably want to listen to this at least once more, and maybe specific things in it, especially the last little bit, maybe more than a couple times. The quote again, if you are risk adverse, you should have most of your money in Bitcoin. In fact, Sam Dixon, Bank of the Future, bankforthefuture.com, that was his quote. He actually goes on to say all of your money should be in Bitcoin in a hardware wallet, somewhere that you have personal access to it, and only the spending money that you need to get you through the month should be in a place where it can be spent that way, where you can make electronic payments, where you can send in your bills from whatever, however you do your bills now. Okay, and that may be PayPal, that may be Venmo, that may be Cash App. There's a lot of different places where you can actually do that. But the world is changing. The world's changing very quickly. This is probably the best advice that I have seen from a true financial advisor. If you're risk adverse, you should have most of your money in Bitcoin. Bitcoin is going to be the stable future. All right, that's what I got for now. We'll talk later.
If these videos are valuable to you, I'd appreciate it if you would support me on my Patreon site, www.patreon.com/darwinstheory. See you soon.